Welcome to the Hughes Optioneering Weekly Workshop, where we scientifically engineer trades for greater profit potential. This is the disclaimer slide. You can pause to read it. We're going to move on. Today we're going to look at YPF, or I'm probably going to murder this. I don't speak Spanish. YPF Sociedad Anonima S.A. YPF explores and produces crude oil, natural gas, and liquefied petroleum gas, LPG. YPF is a leader in unconventional hydrocarbon production in Latin America. Here's the barchart.com technical opinion rating for YPF. The bar chart rating is a 100% buy with the strongest short-term outlook on maintaining the current direction. Long-term indicators fully support a continuation of the trend. According to Prime Trade Select rules, the stock is in a bull trend on a monthly basis. If the stock price is above the 10-period or 10-month simple moving average. The monthly chart shows that YPF is well above the moving average line, so the monthly trend in YPF is up. Now we're going to look at the daily chart. The stock is in a bull trend on a daily basis if the 50-period or 50-day exponential moving average is above the 100-day exponential moving average. The blue line is the 50-day EMA line, and the green line is the 100-day EMA line. The blue line has been above the green line since the chart started, so the daily trend in YPF is up. Next, we're going to look at a daily chart that displays the Keltner channel. As a rule, we don't want to buy calls if the stock price is above the upper Keltner channel line. Anywhere inside the Keltner channel or even below the Keltner channel is fine. YPF is below the upper Keltner channel line, so YPF is inside the buy zone. Since the trend is up, we want to buy a call. YPF has 6 option chains to choose from. We're going to use the Feb 21 option chain. Right now, the February 21 options have 40 days to expiration. Here's the YPF option chain for Feb 21. YPF closed at 45.85 on Friday. That means any calls on the list from 30 to 45 are in the money. Let's take a look at the profit potential for purchasing the 46 strike call, which is the closest strike to the current price of the stock. The bid-ask spread for the 46 call is 320 to 350. We try to enter at the midpoint, so we use 335 as the buy price. We can see that if the YPF stock price is flat at 45.85 at option expiration, the 46 call will lose 100% of its value. Ouch! This is an unacceptable risk. That kind of loss can wipe out our trading account in a hurry. We developed what we call the 1% rule to help us avoid this kind of risk. The 1% rule says to limit the time value portion of the option we buy to 1% of the stock price. That means the stock only has to move up 1% for the call option we purchase to break even and start profiting. Whoops. This is not in the right spot. Well, it's too late now. Now let's take a look at buying the 41 strike call to see if it qualifies for the 1% rule. Here's the call option calculator picture for the 41 call. According to the 1% rule, we want the call to at least break even if the stock price is up 1%. The calculator picture shows that if the YPF stock price is up 1%, the 41 call will lose 14.2% of its value. We want that to be break even or better, so the 41 call does not meet our requirements. Let's see if the 37 call will work. The bid-ask spread for the 37 call is 790 to 970. We try to enter near the midpoint, so we'll use 890 as the buy price. The 37 call works. If the YPF stock price is up 1%, the 37 call will make a 4.6% or $41 profit. That's better than break even, so the 37 call is the one we'll buy. The call option purchase calculator also shows that if the YPF stock price increases by 2.5%. The 37 call will make a 12.3% or $110 profit. If the YPF stock price increases by 2.5%, the 37 call will make a 25.2% or $224 profit. If the YPF stock price increases by 7.5%, the 37 call will make a 38.1% or $339 profit. The 10% and 12.5% numbers are also displayed. You can see that the profits get better and better. And notice that if the YPF stock price does not make the expected move up and remains flat at expiration, the 37 call would only lose minus 0.6% or minus $5 compared to the minus 100% or minus $335 loss for the 46 strike call that we looked at earlier. Now we want to review a call option debit spread, aka a vertical call spread. For this spread, we want to buy to open the YPF Feb 21 38 strike call and sell to open the Feb 21 43 strike call. We're going to base our entry prices on the midpoint between the bid and ask prices. That means we'll buy the 38 call for $8.75 and sell the 43 call for 5.00. So the entry price or debit cost for the spread is $375. I hope that's right. The call option debit spread analysis calculated picture shows that the spread will make a 33.3% or $125 profit. If the YPF stock price declines by 5%, remains flat, or increases in price when the options expire. If YPF is down 7.5% at expiration, the trade will make 17.6% or $66. Creating the debit spread will allow us to collect a $500 cash credit to our brokerage account for the sale of the 43 call. As we said on the previous slide, this reduces the cost of entering the spread to $375. Here's a note regarding earnings reports. The next YPF earnings report is scheduled for March 5th. Let's review the trades one more time. The first trade was a call purchase. It said to buy to open the YPF February 21 expiration 37 strike call for $8.90. We also reviewed a spread. The spread said to buy to open the YPF Feb 21 38 strike call and sell to open the YPF Feb 21 43 strike call at a debit of $375. That's it for this week's Optioneering Workshop. Thank you for joining us. We look forward to seeing you again next week.